Let's welcome on board Pranjul Bhandari from HSBC Securities to try and understand what she's expecting from the GDP print. Pranjul, hi, good morning. While clearly one is going to see a higher year-on-year number purely because of the base effect at play, on a sequential basis, are you as well penciling a decline as most estimates are?
Well, yes, of course. There will be some decline because this was the period when we had the second wave-led lockdowns, across many states of India. So there will be a sequential decline. But I think it's important to note that the sequential decline we are expecting this time around is only about half to two-thirds of the sequential decline that we saw in the first quarter of the last fiscal year when we were in the midst of the first wave. And the reason is, last time we had a very stringent national lockdown. This time it was more state specific. And also this time around, the goods trade was completely allowed. The movement of goods and goods was not really hampered. Last time, even the goods trade had been hampered to a large extent. So yes, a sequential a sequential decline, but not as much as we had seen in the same quarter last year. I just actually wanted to take a step back and point out that today's number, if you even look at the market consensus, it's a huge range. And the reason is there's a lot of uncertainty in the data for many reasons. Number one, our GDP data does not really capture informal sector, or sometimes it captures a part of it and not the other part. And it's very hard to tell which part it will capture. Also, even the corporate results that are included, sometimes not all are included. They all get included eventually in revisions, but not on the day of the first release. So with all of these uncertainties, I think the range this time is very large.
Sure, understood. In particular, tell me, Pranjul, what is it that you're expecting from farm, industry and the services segments to contribute to the GDP print?
Yeah. So look, I think through the entire second wave period, there have been three bright spots. One has been agriculture. Monsoons have been decent in the last couple of years. They got a lot of social welfare scheme support from the government. They were not bothered by the lockdown as much. So I think that is going to be a bright spot. The second bright spot is central government capex. They continued to spend through the second wave lockdown, and the capex numbers are very strong. That's the second good area. The third good area is exports. Our own sense is that India has benefited a little bit from the whole diversification of supply chains, particularly in areas like electronics and machinery. So that has also been, a strong part at this point. So these are three good areas that I'll be watching out for, how much they can surprise on the upside. Generally speaking, I think the trend would be that industry will do far better than services, for the simple reason that manufacturing was not really closed down this time, while high touch services have come under a lot of pressure. So industry doing better than services, and three bright spots: agriculture, exports and government capex are a few of the trends that I'm watching out for.
Okay. Hi Pranjul, this is Mubina as well joining in. Considering the good momentum in rural and capex, and then of course let's not forget that while it's industry that will lead the growth, even services will pick up in the months and the quarters to come. Just to give you an example, we had Mahindra Holiday saying that they are expecting to reach 75% occupancy by the end of this quarter. So services as well will make a comeback. Do you see upside risks to the RBI's FY22 GDP estimate of 9.5%?
Yes, look, I really agree absolutely with the first part of what you said. I think what we have benefited from so far is pent-up goods demand, and not really the full throttle of pent-up services demand, which generally tends to pick up once vaccination rates reach a critical mass. And now vaccines have really picked up in the last fortnight. We are close to 6.5 million per day jabs, which is where I was always hoping we get to very quickly. And with that, we will reach a critical mass soon. And that's when services could start showing up, and growth could be led by pent-up services demand for the next 2 quarters. The second half of the year. So yes, I absolutely agree to that extent. But whether or not RBI should change its forecast in a hurry, I think it's better to wait and watch right now. It's very easy that after one print, you just increase your forecast and then you get one bad print and you cut the forecast. The truth is there are a lot of uncertainties. I think the biggest uncertainty is how much the third wave will hit us. Now, many epidemiologists are saying that perhaps it will not be as bad as second wave, but this pandemic has surprised us in many ways. So I think it'll be prudent for the RBI to just wait and watch for at least a month or two to see where the third wave, if we get one at all, what impact that could have, rather than quickly running and rushing into a GDP growth upgrade.
No, of course, absolutely. Now, your expectations of growth. We focused on capex, and you've seen that there are signs of a pickup in capex. Do you see consumption-led, contribution to the GDP as well for FY22?
Well, yes. Look, even before the pandemic, private consumption was the main source of growth. Actually, private consumption and government consumption, and it can't completely become subdued. Of course, there are issues which people have in terms of the outlook for future jobs and incomes seem to have fallen a little bit as per RBI survey. But generally speaking, there's a lot of pent-up demand still in the system. As I had just mentioned, pent-up goods demand is something that has surfaced, but pent-up services demand, the fact that people haven't taken a holiday for 1.5 years, they haven't gone out to the cinema, they haven't gone out shopping in a mall, all of that can come up very quickly once vaccination reaches a critical mass. A large amount of people are vaccinated. So yes, from that perspective, I do think that consumption will remain a mainstay of GDP growth, at least in this fiscal year.
Pranjul, hi, Alex here. Expanding the the view just a little bit beyond just GDP. Of course, this is something that the RBI is going to be looking at very, very closely. But in terms of the minutes of the last meeting, where there was one dissenter where there were concerns expressed about inflation as well, the RBI Monetary Policy Committee has clearly been walking a tightrope of late. The normalization of a policy. Do you think that could happen early next year? Are you putting a time to it? How do you expect that to pan out?
Vaccination remains as buoyant as it has been in the last fortnight. My sense is that by December, about 85% of India's adult population could be fully vaccinated, and that's a big number. I think once we get there, and then we see a huge amount of pent-up services demand, which over time can also be inflationary. We've sort of found that growth which is led more by services tends to be more inflationary. Goods you can import away, but services by nature you can't import. So once the demand rises, it can become inflationary very quickly. So that is something the RBI will not be able to ignore. Our own sense is that towards the end of this calendar year, in the last quarter, it will start, a very gradual normalization process. And I think the first step would be sucking out, some of the surplus liquidity with more surer steps. I think that's probably going to be one of the first steps. The second step could be raising the reverse repo rate, which means normalizing the corridor. So these are few things I'm expecting towards the end of this calendar year and towards the beginning of the next calendar year. But repo rate hikes, repo rate is at 4%, it's our main benchmark rate. Those hikes, I think, will wait. I think that will come only towards the second half of 2022.
Having said that, and I take your point entirely on the liquidity measures that are currently in place, based on what you anticipate happening, what kind of a bearing do you think that's going to have on the currency as well as on bond yields?
Yeah. So look, the currency, at this point, you must also remember that the global economy is changing quite a lot towards the end of the year. Some of the advanced economies, may also start talking more surely about normalization. So, whenever that happens, like a taper, the emerging market economies do face the brunt of it. So that's something we have to be aware about. But having said that, this is nowhere close to where we were in 2013. Firstly, the current Fed chairman is sort of going more softly on it. It's not like what we had seen with Ben Bernanke back in 2013. Second, India has a mountain of FX reserves, record FX reserves. Third, India seems to be getting a lot of inflows. In fact, I must say that my biggest surprise of 2021 has been the fact that inflows have remained so strong. And we see a lot of pickup in areas, for example, new age tech, digital, all of that, VC funding, PE funding, FDI, all of that has, really been surprising on the upside. So, cutting a long story short, currency is going to be a function of what all emerging markets face. But today, India is much, much stronger than it was in 2013. As for bond yields, again, totally a function of fiscal deficit and the supply of bonds in the system. Our sense is that towards the end of the year, bond yields could rise and go closer to 6.5, given that, there will be borrowing in the system. It's not huge borrowing. There is not likely to be a huge fiscal slippage, but yet, at some point, when supply is more than demand, then you start seeing bond yields going up. So we are calling for 6.5 towards the end of the calendar year.
Okay. Pranjul, great to have you on the show. Thanks as always for taking the time out and speaking with us today.